You're watching In Your Interest. I'm Krishna Kumar, and In Your Interest is interest rates. The U.S. Federal Reserve, America's central bank, on expected lines, cut its benchmark interest rate by 25 basis points, bringing it down to a new range of 4.5 to 4.75%. This followed the larger 50 basis point rate cut in the month of September this year, which already lowered rates from the high of 5.25% to 5.5% seen early this year. The goal of these cuts is to ease borrowing costs across the U.S. economy, from credit cards to auto loans. The effort is to stimulate growth as inflation continues to moderate and the labor market shows signs of softening. Inflation, which peaked at a staggering 9.1% in June 2022, has now come down to just 2.4%, bringing it closer to the U.S. Federal Reserve's 2% target. While this move is aimed at providing some relief, it raises some important questions about the broader economic and market outlook of the U.S., with expectations of additional rate cuts next year already being recalibrated and U.S. Treasury yields rising despite the rate cuts. What does all of this mean for investors like you watching this broadcast? What impact might this have on global markets, particularly emerging economies like India? Joining us today to discuss that is Rohit Srivastava, founder and market strategist at IndiaCharts.com, who will help us break down the implications for both the US and global markets, including India. Rohit, thank you so much for being with us. So talk to us. The US Fed has cut interest rates by 25 basis points. Now, although the Fed chair, Jerome Powell, said that Trump's return will have no near-term policy impact, it seems like the market is pricing fewer rate cuts than the 4 that were projected for the next year. What's your sense of things?
So some of the theory holds that the Federal Reserve follows the 2-year benchmark interest rate, the bond yield. And in the near term, because of this recent election, the bond yields have actually risen a bit. Of course, they've risen less on the 2-year, a lot more on the 10-year. But that rise has sort of pushed people back a little bit on what might be the trajectory in terms of number of rate cuts. But what the FOMC has made very, very clear is that they are on the right direction in terms of rate cuts. They just don't know the quantum and what will be the what they call as the normal interest rate at which, the neutral rate basically at which they would be comfortable. So that all depends on data, how the inflation data is going to play out. In fact, I was listening, they're pretty clear also that inflation data will actually start dropping by February. The reason is that there are certain base effects taking place, which means last year's numbers were high and therefore current year's numbers, even though they are flattening out, they are not appearing to be low, even though they should have been lower. So that will only get reflected by February. And if that is true, then they will continue to have several rate cuts on the table. So that is it. The words of Jeremy Powell yesterday, what I heard in the press meet. So if that is the case, one thing is clear, is the direction of rates, right? They're going to be heading down. The risk that people are stating is got to do more with the political environment, getting into whether Trump will overspend and that will cause inflation or cause the fiscal deficit to rise, and whether that would put pressure on the bond market. But if I just hear his initial statements, he said two things. He said one side he wants to cut taxes and the other side he wants to manage debt. So he himself is well aware of the situation, that he's not going to let it go out of control. So I think we shouldn't read too much into it, but there are in fact more positives than negatives from the overall scenario. Put it all together, lower taxes, lower rates, and some balance on the debt side is actually sounds like good news. In fact, the last thing he said is there'll be lesser geopolitical risk because we will not get into war. So that, I think, is the icing on the cake if you think of just the sentiment on the street, which is why US markets reacted a lot more positively than Indian markets. Now, Indian markets are recovering from what has been a pretty harsh sell-off, which is why we are not seeing it run away along with US markets right away. But I think most of the selling is over because seasonally, this is a weak period. September, October is when you typically get some kind of a correction. And even from the US election perspective, you do see a correction prior to US elections. And then you see what is called as a presidential rally, which runs for several months after the election. So if you put both of them together, at least for the months of November and December, I think we're looking at a seasonally positive period for equities. And therefore, what I would look at is being bullish or long on equities for the next month or two at least, and then consider things as they develop over that.
Rohit, there was that 50 basis point rate cut in September. Treasury yields since then have climbed. It's counterintuitive. Theory would suggest that bond yields are supposed to fall when there's a rate cut. Help us understand this anomaly.
So somewhere markets tend to discount things well in advance of our understanding them. So let's put it this way: the expectation of rate cuts were building all the way from July, August, right? And so bond yields were actually falling all the way from July into the September Federal Reserve meeting. Same with the dollar index, right? It was falling July, August. It was falling, and finally it got to a point where it had fallen a lot. So what happens is you've heard this old adage, right? Buy in expectation, sell on news. The same thing works here. You sold the dollar in expectation that there are rate cuts coming. And on the day of the event, it sort of bottomed out in the next couple of days as the event got discounted. Now, the reverse started to happen after September. Once the event was discounted, you started to think, oh, well, now Trump is coming and he's going to spend more. Maybe rates can't go down that much or that fast. And bond yields and the dollar started to rise. Now, once again, I would expect the same pattern. And you can see that yesterday, that into the election results, the dollar was spiking very sharply higher 2 days ago. Yesterday, it gave back sort of more than half the gains it made 2 days ago. Same with things like copper prices, which had fallen very sharply. They recovered all the losses they made day before yesterday. So these are, I think, knee-jerk reactions, or rather what we say as the discounting mechanism of market. They anticipated it in advance. Once the event is over, a couple of days after the event, you actually see these trends reverse. And now what we should be watching out for is that bond yields actually start declining from here and the dollar starts falling from here. And that will then give us a clear sense of, what you're saying, that, if they're going to be cutting rates, yields should go down. That is what we will see in the period ahead from going ahead from here.
Rohit, typically a rate cut in the US is meant to be good for emerging markets like India. Do you think that this can put the plug on FII selling in India?
Yeah, very, very interesting question. I actually wrote a note on that, which is not yet gone on my social media. And the note was actually sort of instructive or even educational, in a sense that, when we study wave theory, we try to say that news doesn't drive the markets drive the news, which means that markets really reflect the social mood of the crowd at large, what they are thinking, what they are feeling. That is the sentiment. And that sentiment results in news flow. So if the sentiment is very positive, it eventually, after markets rise, you get positive news. Similarly, if markets are falling, sentiment is negative. When it gets more negative, you get negative news flow. Now, how does this play into the FII angle? So you look at the USD INR, it has actually been trying to go up for months and months, but you haven't really seen a very significant advance in the currency pair. Okay. At the same time, it is forming something that we call as an ending diagonal. It's a very technical term for something that is coming to an end, and it has been going on for more than a year. Now, I am hoping that the high we are making today, we are almost hitting a new all-time high again today, is close to the top end of the range for the USD INR for some time to come. Now, if that does turn out to be true, because we also spoke about the dollar index coming down. So if the dollar index starts to fall and the USD INR does roll over from here, my sense would be, the answer to your question would be yes. Okay. It should be the turning point of FII flows, because we've really been seeing too much of outflows, and the currency has been weak simultaneously. So when we see a setup that tells us, yes, the mood is about to change, I would start anticipating that the FII mood towards India will actually change in this environment where you have a weak dollar. The USD INR also starts rolling over, so you actually get lower risk from the currency side. And there should be a need to allocate money to India, which has been one of the outperforming emerging markets, I think. But still, there's just one lasting argument, and I don't know whether the Modi government can really address it. And the lasting argument is that since they started to put withholding taxes on foreign institutional investors way back in 2015, when you actually look at the annual inflows of FIs year after year, you'll find out of the last 10 years, 7 years are outflow. Okay. And what is the reason for that then becomes the bigger question. And somewhere it has to do with taxes, because foreign investors, when they're actually taking a call on which countries to allocate, they like tax havens. They don't like to get into places where they're going to be taxed, and that is a critical part of the decision making process. So that may be a hidden backup reason why the negative flows may remain a long-term issue. But even then, I think the extreme selling that we've seen last month should actually go away.
There's so many factors impacting the markets at this point in time. There is the China stimulus, which is attracting money into China. Corporate earnings have been disappointing. They haven't inspired too much confidence since then. Talk to us. China's stimulus measures, even though they've climbed up quite significantly since the first set of stimulus measures, they remain significantly cheaper than Indian markets. Talk to us. Do you think this will limit the upside potential?
I don't look at China as such a big factor, because if you see the historical performance of Chinese stock markets purely on an index basis, we have done far better on a 10-year or a 20-year basis. So that sort of is not a broad reason. But in the short term, you do get tactical plays. July, August, I was continuously publishing notes saying that China was close to the bottom, close to the bottom. It didn't happen till they announced this massive stimulus. Now, after the stimulus, the market's gone up 50% in a very short period of time. Now, when you get a 50% return, you can't expect it to keep going up 50%. So now again, on a 3-month basis, if we say tactical, I wouldn't expect China to go up too much. Eventually they will, but now because they've moved up so much so fast, it's going to take time for it to consolidate and build for the next move. So in the meantime, India has room to again perform relative to China as far as the 1 to 3 month kind of time frame is concerned. And then at some point of time, you'll see China perform again. So that is the tactical aspect of China. But I do think the worst is over. I do think that the steps they are taking have actually changed the sentiment there. But it takes a while for economic activity on the ground to actually start showing up and additional measures to flow through from the rate cuts. And so that will take time for it to happen, but it will definitely change for the better. So that is the view on China. Now, India is going through what we call as an earnings cyclical downturn. And the hope is that at some point of time that would pick up. I think there is a case that government spending, which had significantly cut back in the first half of this year because of elections, does pick up in the second half because they have to complete those targets that they set out in the previous budget. And that may create some kind of a positive rub-off on spending on earnings in the second half of this year. So I think the earnings cycle is due to pick up. I can't say exactly at what pace it would pick up, but things should improve a little from here. What could be an additional kicker is if we can get ourselves to a lower interest rate regime in India as well. The whole world is moving towards that. We still have not. And that would then allow us to take a bet on things like interest rate sensitive sectors, autos, real estate, banking, and metals, which are the hidden effect of course, the dollar itself, which we discussed before. So these 4 sectors are on my focus for anything that happens on the rate side, which could help trigger meaningful rally in markets.
Okay, talk about interest rates, Rohit. Do you think the RBI will go in for that rate cut in December?
It still looks difficult. If I just go by their language, even though the whole world has moved there, from their language, I think they are still wanting to be a little careful. Note today, the USD INR is at an all-time high. So this is not the place at which they would want to really take the risk of weakening the currency by cutting rates. So I think what they will do is actually wait for the dollar decline to start, watch the currency start to strengthen, or maybe watch for foreign flows to start coming in. And once that happens, it will give them greater comfort to start cutting rates. So they'll not risk the currency in really doing so. And that I think is the mute point. So till that stabilizes, till we see stability in the currency market, I think the RBI might still hold back a little longer.
Rohit, before we let you go, talk to us. Do you think this rather conservative approach by the RBI is the right one? What would you do?
As stock market investors, we always hope what is good for us. So I would like them to cut rates. I don't know whether it's the right thing or not. I mean, they can take some risk. I thought they could have taken some risk when the USD INR was a little lower. At this level, I wouldn't. I mean, at an all-time high, I wouldn't suggest a risk. But when the currency was a little lower a couple of months back, I did think, I hope they move in that direction, but they don't seem ready to do so. So that's fine. At least what they have done in the last meeting is, in terms of their language, they have changed their language, more towards a neutral stance. And that's one step towards the idea that they want to cut rates. It's just a matter of timing. I don't know whether it happens in December, but it is an eventuality that's going to follow world markets. And you can see that in bond yields. So if you actually look at the 10-year GSEC, it did come down a lot. It's moved up a little bit with the global bond yields, but not too much. And so if it starts falling again, I think the GSEC will be an advanced indicator of what maybe the RBI is likely to do. And that's what we should then keep watching.
All right, we'll leave it at that. Rohit Srivastava, thank you so much for taking time out to speak to us here on News9 Live. And with that, we wrap this edition of In Your Interest Up. Thank you so much for watching. This is Krishna Kumar signing off.